Welcome back. We have seen some softness to start the Monday trading session. Let's dig deeper into the mood of the markets right now as we look at the TSX off about 100 points, 0.5%, similar decline for the S&P 500. Of course, what's complicated right now is you had that really strong start to the year, and now investors seem to be doing a fresh reassess. Let's bring in Tony Dwyer, Chief Market Strategist at Canaccord Genuity. Tony, it's always great to have you with us. Welcome back.
Great to be with you, John. Thanks for having me.
What's your general characterization of what's happening right now?
I'll tell you what, there's going to be something that is going to be uniquely wrong in this cycle. So either the macro factors that are calling for a recession that we've highlighted are going to be wrong, and the market's not going to go back to the October low, or the market momentum that has shown that we may be in a new bull market is going to be wrong. And we're kind of, so John, if you remember, one of the times we've been on the show, we were looking for that year-end rally, because anytime the S&P had been down more than 20% through the first 3 quarters of a year, it had closed higher by a median of about anywhere between 8 and 12%. So it closed the year up about 7%. So it was following the historical precedent pretty well. We're about at the level we were in early December, and the market doesn't know which way to go. And the good news is, and here's what I really want to pass along. You don't have to guess at which side is right. You're getting paid almost 5% on short-term instruments like a T-bill to wait and see if there is going to be a recession or to be able to disprove it.
Which would mean that you have a balanced portfolio?
Well, no, if you, like, in other words, down 25%, the market's discounting something of a recession. We talked about an extreme whoosh back then. That's what really caused that rally off that October low. So you're not down 25% again. You've already rallied back to the point where you're only down 14% from the S&P from peak. So to say that the market is discounting recession isn't accurate anymore. Maybe back in early October it was. So given that, I don't think you need to chase the strength. I think there's this rush of you've got to go in because the momentum is there. And then the other side is you got to sell here because and bet against it because you're so far off that October low and we might get a recession. But think about what a 4.8% return in the T-bills will give you. It's almost as good as the 5% earnings yield for the S&P 500 based on our 210 2023 estimate. The 10-year note yield's it's got a 3 handle on it. Even the Moody's AAA bond yield is around where it is. So you're not getting any outsized returns to take the risk. So I think it's a good wait and see. Let's make sure we're not in a recession.
The other part, though, it strikes me that we don't talk a lot about the simple fact. I mean, you kind of alluded to it just in talking about those 2 cases for the market. The market goes up and the market goes down. And don't get me wrong, there are a lot of people who watch every day because they are very active with their portfolio and with good reason. But had you been out of certain sectors, let's say, as things were taking a hit last year, and then we're feeling that, whatever it is, FOMO, feeling like you had to get back in, it kind of discounts the whole reality that if you hadn't been out of the market, you might not have missed some of those early returns already.
Well, that's the problem. You came into 2022. Everybody came into 2022. You got to be long the FANG stocks. It's a new, generational move in them. And then they came into 2023 with you've got to be long the cyclical stocks because there's a high prospect of a soft landing. The problem with that too, John, is since the beginning of the year, the cyclical stocks that would reflect a better economy have underperformed. Even the materials have underperformed now. So you're in this situation where the market is sending so many mixed signals. Listen, people like me love to come on TV and tell you, with high conviction of what's going to happen. Buddy, I don't know at this point because you've got very clear recession indicators. When the yield curves are inverted like this, when the leading economic indicators are this negative, you've always gone into recession. But then on the other side of the trade, when you've had a breadth thrust like this, which our own Javed Mirza has pointed out, when you've had this kind of breadth thrust, it's an indication of a new bull market. John, I don't know which one's right. Here's what I know. We're already up 10% from more than 10% from the low, and I get paid 5% to try and figure it out.
Right. Right.
Not too bad.
Yeah, no, that's helpful context. Before I let you go, though, I know you're largely focused, Tony, on the situation in the U.S., and we have seen those technology stocks running up there. But it gets us into an interesting conversation about the makeup of the Canadian market, where you've got these technology stocks here that have done well, whereas a lot of people came into this year making a continued bullish call on energy. We've already had a conversation around that this morning, and energy has lagged. Where do you find yourself in the camp of, okay, well, look, we're going to get to some point in the year and China's reopening will continue and the OPEC Plus members have not committed to any additional production, and all of a sudden we're going to be talking about a supply story? I mean, where do you weigh in on energy as a sector within this period while you're getting paid to wait?
Listen, I literally was begging some clients to not increase their exposure in energy at the end of the year. If you do believe there's a soft landing and certainly a recession, that doesn't coordinate well with strong energy prices. The issue, I think, with all the cyclicals and energy included, John, is going to be around the dollar. The dollar has seen about a 10% drop from its peak, the U.S. dollar index. It has pulled back to its breakout point. How it acts from here is really, I think, going to be the determinant of what the international and actually the U.S. markets do. At this point, I'll leave you with this. Our game plan for this year, coming into this year, listen, we got defensive last year. A year into this is not the time to get Armageddon negative. So we call it being light and tight. If you have the opportunity to have enough cash, you just buy the T-bills, that's good. If you're a long only, we advise institutions in the U.S. If you're a long only investor, then you just have a slightly defensive bias. Again, you don't want to, this far into a bear market, you don't want to be too negative, because if you do go back to that October low, which is still our base case, I want to attack that low. I don't want to have to panic because of it. And the only way you can attack that low is if you're not too bearish and you have some cash available.